Most traders abandon sideways markets, convinced nothing is happening. But while you were looking away, Bitcoin consolidated for months in 2020. Volume quietly dried up, professionals absorbed every sell order in silence, and then exploded 300% upward. That boring range wasn't dead money, it was the cause being built. The law is absolute: the longer the range, the greater the effect. The explosive move you're chasing, it was born in the silence you ignored. Every day, thousands of traders stare at their screens, watching price move sideways, grinding, chopping, going absolutely nowhere. Their capital is sitting idle. Their confidence is eroding. Their peers are posting profits from trending markets elsewhere. The conclusion feels obvious and unavoidable: this market is dead. There is nothing here worth my attention, so they leave. They close the chart. They chase something moving faster. They abandon the one market that was quietly, methodically, preparing to hand them the most significant opportunity of the year. This is the most expensive mistake a trader can make, and it is made daily by the majority. Understand something fundamental about how markets truly operate. Price does not simply decide to move explosively one morning. There is no spontaneous combustion in financial markets. Before any significant directional move, whether in the S&P 500, Bitcoin, crude oil, or any modern instrument traded today, a preparatory process must first be completed. That process lives inside the trading range. When price moves sideways, large professional operators, institutions, funds, algorithmic systems controlling billions in capital are doing the most important work of the entire market cycle. They are systematically absorbing available supply or distributing accumulated stock, contract by contract, session by session, without alerting the uninformed public to their intentions. In today's markets, this process is even more sophisticated. High-frequency algorithms execute thousands of orders invisibly. Dark pools absorb institutional volume away from public exchanges. Yet the footprint remains identical to what I observed over a century ago, because the law governing it never changes. Supply and demand leave their marks on price and volume, regardless of who or what is executing the orders. Watch the volume carefully as the range develops. In a genuine accumulation range, you will observe something most traders completely misread: volume contracts. Price volatility narrows. The market appears increasingly uninteresting. What is actually happening is precise and deliberate. Available selling pressure is being absorbed and eliminated. Each wave of supply that enters the market finds a professional buyer waiting quietly beneath it. The range is not a pause. It is a vault being filled. The longer price remains in this condition, testing extremes, absorbing supply, eliminating weak hands, the greater the cause being constructed. And by the immutable law of cause and effect, that greater cause will produce a proportionally greater effect when price finally breaks free. This understanding changes everything about how you approach sideways markets. The modern trader, who recognizes a developing range, who studies the volume behavior, identifies the phase of development, and positions themselves patiently within it, does not chase breakouts. They are already positioned before the breakout begins. They hold through the explosive move that everyone else scrambles desperately to enter late. The range was never dead. It was always the beginning of everything. You entered the breakout. Price exploded from the range with conviction. Volume surged. Every indicator confirmed the move. You committed your capital with confidence. Then, within days, the move fizzled. Price stalled, reversed, and returned directly back into the range that supposedly launched it. You did everything correctly, or so it appeared. Yet the market punished you anyway. The question that haunts every serious trader after such an experience is not what went wrong, but rather what was never there to begin with. Most traders evaluate a potential trade by studying the breakout itself, the size of the candle, the volume spike, the momentum indicator reading. They are measuring the effect while remaining completely blind to whether a sufficient cause was ever constructed to produce a sustainable move in the first place. This is the critical error, and it is destroying trading accounts across every modern market, every single day. The law of cause and effect is not a theory. It is the governing principle behind every meaningful price movement that has ever occurred across every financial instrument in history, from the stock markets of the early 20th century to today's cryptocurrency exchanges, futures markets, and foreign exchange pairs operating around the clock globally. The law states this with absolute clarity. An effect cannot exceed its cause. The distance any trend movement will ultimately travel is directly proportional to the time and effort invested in constructing the preceding range. Consider two accumulation structures in Bitcoin. The first consolidates for 3 weeks, narrow range, modest volume activity, limited professional participation. The second consolidates for 4 months, progressive volume contraction, multiple tests of support, clear evidence of systematic absorption across hundreds of thousands of contracts. Both structures eventually break upward with similar-looking candles on the day of breakout. The trader measuring only the breakout candles sees 2 identical opportunities. The Wyckoff trader measuring the cause sees something entirely different. The first structure carries potential for a modest move. The second carries potential for a generational trade. Same breakout appearance, completely different causes, completely different effects. In today's markets, this principle operates with even greater mathematical precision. Institutional algorithms are programmed to build positions across extended time periods, specifically to minimize market impact. The longer and more methodically a range develops, the larger the position being constructed beneath the surface. A larger position requires a larger move to distribute profitably, meaning the cause literally determines the minimum distance the subsequent trend must travel. This single understanding restructures your entire approach to trading permanently. You stop measuring breakouts. You start measuring causes. You stop asking how strong is this candle and begin asking how significant was the preparation that preceded it. Every explosive move you have ever envied, every trade that seemed to produce life-changing returns for those fortunate enough to hold it, was preceded by a cause large enough to justify exactly that result. The cause was always the answer. It was simply waiting to be read correctly. You have studied the chart for hours. The structure looks correct. The range appears well defined. Every visual element suggests accumulation is developing beneath the surface. You prepare your entry with conviction, and then something stops you cold. You cannot determine with any certainty whether professionals are actually buying this market or quietly selling it into every rally. The price action alone gives you no definitive answer. Both scenarios look identical from the outside. One leads to explosive profits, the other leads to a devastating loss as price breaks downward through your stop. You are trading blind, and you know it. This paralysis is experienced by every serious trader who relies solely on price patterns without understanding the one element that separates informed analysis from sophisticated guesswork. The answer has been available on every chart, in every market, across every time frame, sitting directly beneath the price bars, consistently ignored by the majority of modern traders chasing patterns and indicator signals. That answer is volume. Volume is the only direct window into professional activity that exists on a publicly available chart. Price can be manipulated temporarily. Patterns can appear deceptively similar across opposing scenarios. But volume, the actual quantity of contracts, shares or units exchanging hands at any given moment, reveals the true level of participation and urgency operating beneath the surface. Understanding how volume behaves within a trading range transforms your analytical capability permanently. In a genuine accumulation range, observe what volume does as the structure develops across time. It contracts, Progressively, methodically, the overall volume traded during each successive wave decreases. This is not coincidence or random market behavior. This contraction represents the systematic elimination of available selling pressure. Each time price tests the lower boundary of the range and volume diminishes compared to the previous test, professionals are communicating something precise. Supply is being absorbed, sellers are losing conviction, and the floating stock available for sale is approaching exhaustion. In today's markets, modern volume analysis tools make this reading even more powerful. The wave indicator measures cumulative volume across complete price waves, allowing you to directly compare the effort expended on each downward wave against each upward wave developing within the range. When downward waves progressively shrink in volume, while upward waves maintain or increase their volume, the imbalance being constructed in favor of buyers becomes visually undeniable. Conversely, a distribution range presents the opposite signature. Volume remains elevated and relatively constant throughout development. Wide price fluctuations persist. This sustained high volume reflects the continuous effort required to absorb incoming demand. Professionals selling into every wave of buying interest the uninformed public generates. The volume profile adds another dimension entirely. When the point of control, the most heavily traded price level within the range, consistently acts as support during pullbacks, it confirms that institutional interest is concentrated precisely at that level, defending it deliberately. Volume never lies about who controls the market. Every accumulation range that preceded a historic breakout carried this signature, quietly contracting volume, confirming absorption, progressive elimination of supply, professional hands gaining undisputed control beneath complete public indifference. You now possess the lens to read it. You have been patient, disciplined beyond what most traders are capable of sustaining. You identified the range correctly. You read the volume contraction precisely. You positioned yourself carefully near the lower boundary, confident that accumulation was completing beneath the surface. Then the market breaks violently downward, directly through your stop loss, through the entire support structure you trusted, through every level that supposedly confirmed professional buying. Price plunges into territory that makes the entire accumulation thesis appear catastrophically wrong. Every analytical conclusion you reached now feels not merely incorrect, but embarrassingly naive. The market has exposed you completely. Every experienced trader has lived this moment. The sudden, aggressive violation of a range boundary that appears to invalidate weeks of careful analysis in a single devastating candle. The instinct screaming to abandon the position, accept the loss, and conclude that the original reading was fundamentally flawed. This instinct, however powerful and emotionally compelling it feels in that precise moment, is the most expensive reaction a trader can surrender to. What you are witnessing in that violent breakdown is not the failure of your analysis. It is the confirmation of it. The shake, whether appearing as a spring in accumulation or an upthrust after distribution in distribution, is the single most deliberate, calculated maneuver that professional operators execute across the entire range development process. It is not random volatility. It is not panic selling overwhelming institutional support. It is an engineered event executed with surgical precision for purposes that serve exclusively the professionals constructing the campaign. Understand what is actually occurring during that violent move. Large operators need one final, massive injection of liquidity before launching the trend movement. They require counterparty volume, sell orders to absorb for their buying positions on a scale that normal range trading simply cannot provide. By driving price aggressively below a well-established support level, they simultaneously trigger three enormous sources of that required liquidity. Stop losses belonging to traders correctly positioned long are executed automatically. Algorithmic breakout systems detect the support violation and generate fresh short positions programmatically. Emotionally driven retail traders, convinced the range has failed, enter aggressively short, providing the precise counterparty volume. Professionals need to complete their accumulation at the lowest possible prices. In today's electronically driven markets, this mechanism operates with extraordinary efficiency. High-frequency trading systems amplify the initial move. Momentum algorithms pile onto the breakdown. Social media amplifies the apparent collapse, creating maximum fear and maximum liquidity simultaneously. The spring in 2024 markets produces deeper penetrations and faster recoveries than anything observed a century ago, precisely because modern technology concentrates the liquidity generation into compressed timeframes. The critical reading comes immediately after the violation. Volume behavior during the recovery reveals everything. A genuine spring recovers rapidly. Price re-enters the range decisively, and subsequent tests of that broken level occur with progressively diminishing volume, confirming supply exhaustion at that critical zone. The shake is not the range breaking down, it is the range confessing its true intention, loudly, violently, and unmistakably, to every trader disciplined enough to recognize the deception for exactly what it is. The explosive move always begins precisely where the majority finally surrendered. The alert fires. Price explodes through resistance with a massive candle. Volume surges to levels not seen in weeks. Every trading group, every financial news channel, every social media account covering this market erupts simultaneously with the same urgent message. The breakout is happening right now. You feel the pull immediately. The fear of missing a move that appears to be accelerating away from you by the second. The mental calculation of how much profit is already gone with every moment of hesitation. The voice insisting that this time, the move is real, the breakout is genuine, and waiting any longer is simply leaving money on the table. So you enter. At the top of the breakout candle, with maximum emotional commitment and minimum analytical clarity, and then you watch in disbelief as price stalls, reverses, and methodically dismantles every point of open profit before driving directly into your stop loss. The breakout that appeared so powerful, so confirmed, so absolutely undeniable, was absorbed by the very professionals who engineered it. You did not miss the opportunity. You arrived precisely when the opportunity had already ended. This pattern repeats across every modern market, every time frame, every tradable instrument, with absolute consistency, because the fundamental misunderstanding driving it never changes. The breakout candle is not the opportunity. It is the announcement that the opportunity has already been taken by those who understood what was being constructed before price ever reached that resistance level. The breakout is the effect. The cause was built inside the range, and the traders who positioned themselves within that range at the spring test, at the last point of support, at the precise locations where professional accumulation was confirming itself through volume behavior, those traders are not watching the breakout with urgency. They are managing an already profitable position while the crowd frantically chases the move they helped create. Understanding this distinction restructures every decision you make as a trader. The question is never should I enter this breakout, it is always was I positioned inside the cause that produced this breakout. One question leads to reactive, emotionally driven trading with consistently poor risk to reward ratios. The other leads to deliberate, analytically grounded positioning with the kind of risk management that makes sustainable profitability genuinely achievable. In today's markets, chasing breakouts carries even greater inherent danger than in previous generations. Institutional algorithms are specifically programmed to identify and exploit retail breakout behavior. The moment price violates a well-publicized resistance level and retail volume floods in from breakout traders, Professional systems are simultaneously distributing into that demand, using the very liquidity the crowd generates to exit positions opened far below at superior prices. The spring test entry positions you with a stop loss at the range extreme, frequently representing 1 to 2% of price. The breakout chase entry positions you with a stop loss back inside the range, representing 5 to 10% or more, with a risk to reward ratio that makes consistent profitability mathematically implausible regardless of directional accuracy. Consider what this means practically. A Wyckoff trader who correctly identified the spring test entry in a major accumulation structure holds a position with defined risk established at range lows, capturing the complete effect of the entire cause as price moves through the breakout level and continues the trend movement beyond it. Their profit target was established before the breakout occurred. Their stop loss was placed before the breakout occurred. The breakout itself requires no decision from them whatsoever. The explosive move you are desperately chasing on the breakout candle is the same move that a patient, analytically disciplined trader entered weeks earlier. At the precise moment the market appeared least compelling and most uncertain. The opportunity was never in the breakout. It was always in the preparation that the majority watched with complete indifference, waiting for something exciting to happen, never recognizing that the most important moment had already passed them entirely. You have identified what appears to be a textbook accumulation structure. The selling climax is clearly visible. The automatic Riley established a clean resistance level. Volume contracted precisely as expected through phase B. The spring developed with diminishing supply and recovered convincingly back into the range. Every element of the structure appears legitimate, properly sequenced, analytically sound. You enter long with complete conviction. Then the larger market collapses. A distribution structure that had been developing across a higher time frame, one you never examined, never considered, never even acknowledged existed, completes its bearish breakout directly above your position. Your perfectly constructed accumulation structure gets demolished not by anything within it, but by forces operating at a completely different level that you were never watching. The structure was real. The reading was correct. The context was completely ignored. This is perhaps the most sophisticated and most consistently overlooked dimension of market analysis available to the modern trader. Countless technically proficient analysts identify individual structures with impressive accuracy, yet systematically produce inconsistent results because every structure they analyze exists in complete isolation from the larger market environment surrounding it. A structure analyzed without context is a sentence read without understanding the paragraph containing it. Technically accurate, fundamentally incomplete. Context, within the Wyckoff methodology, operates across every dimension of market analysis simultaneously. It governs time frames. It governs the directional bias applied to every trade considered within a developing structure. It governs the interpretation of individual events, transforming the identical price action from a high probability opportunity into a dangerous trap depending entirely on what the larger structure surrounding it is communicating. The vital rule is stated with absolute clarity: always trade in favor of the larger structure. This single principle, properly internalized and consistently applied, eliminates the majority of analytical errors that destroy otherwise competent trading approaches. Consider how this operates practically in today's markets. A reaccumulation structure developing on a 1-hour chart carries dramatically different implications depending on what the daily chart is communicating simultaneously. If the daily chart shows price operating within phase D of a major accumulation, having completed its spring, confirmed its breakout, and now developing the upward trend within range, that 1-hour reaccumulation is not merely a standalone trading opportunity. It is the backup to the edge of the creek of the larger structure, carrying the full weight of the major cause behind every long position taken within it. The risk-to-reward calculation changes entirely. The conviction required to hold through minor adverse movements increases substantially. The profit target expands dramatically because the effect being generated draws from two causes simultaneously, the minor structure and the major one supporting it from below. Conversely, identifying a seemingly attractive accumulation structure while a larger distribution campaign is completing above it produces the most dangerous category of trade available, one that appears analytically justified at the level being examined while being fundamentally opposed to the dominant force controlling price at the level that actually matters most. In modern markets operating across cryptocurrency, futures, equities, and foreign exchange simultaneously, this multi-layered context analysis becomes more critical than ever before. Correlations between instruments create macro-level contexts that influence individual structure development in ways that would have been impossible to observe in earlier market generations. Bitcoin developing an accumulation structure while the broader crypto market completes a major distribution above it faces headwinds that no amount of precise micro-level analysis can overcome. The Wyckoff trader operating in today's environment examines every potential trade through a minimum of 2 time frames simultaneously, using the higher frame to establish directional bias and identify the dominant structural phase, then descending to the trading frame to locate precise entry opportunities aligned completely with that bias. Context does not merely improve your trading analysis, it transforms isolated pattern recognition into genuine market comprehension. The difference between a trader reacting to individual structures and a trader reading the complete story, the market, is telling across every dimension simultaneously. Every structure exists within a larger structure. Every move serves a larger purpose. Every range builds a cause that belongs to a campaign far greater than what any single time frame reveals. Read the complete story. The market has always been telling it, to every trader disciplined and patient enough to step back far enough to see it clearly. Every year, an overwhelming majority of traders enter financial markets carrying the same fundamental conviction that success belongs to those who move fastest, react quickest, and chase the most visually compelling price action available at any given moment. They scan for explosive candles. They chase breakouts already in motion. They abandon sideways markets the instant price stops delivering the immediate gratification their impatience demands. And every year, that same majority produces the same result. Inconsistent returns, deteriorating confidence. The persistent, suffocating feeling that the market is specifically designed to punish every decision they make, as though professionals on the opposing side can see their orders, anticipate their reactions, and systematically extract their capital with effortless precision. That feeling is not paranoia. It is the accurate perception of a trader operating without the foundational understanding that separates those who consistently extract wealth from financial markets from those who consistently donate it. Everything examined across these 6 keynotes leads to a single, unified conclusion that has governed profitable trading across every market, every instrument, and every generation of financial history without a single exception. The market does not reward speed. It rewards comprehension. Trading ranges are not obstacles between exciting trend movements. They are the most important condition the market produces, the only environment where the cause is constructed that makes every subsequent trend movement possible. Without the range, there is no explosive move. Without the cause, there is no effect. Without the preparation, there is no campaign. This sequence is not occasionally true. It is universally, mathematically, and permanently true across every market that has ever existed. Volume does not merely accompany this process. It narrates it, revealing with precise clarity whether professionals are accumulating or distributing, Whether supply is being absorbed or demand is being exhausted, whether the cause being constructed will produce an upward effect or a downward one. Every contraction of volume within an accumulation range is a sentence in that narrative. Every diminishing downward wave is a paragraph. Every successful spring test with negligible selling pressure is the final chapter announcing that the cause is complete and the effect is imminent. The shake is not a threat to your analysis. It is the market's most honest moment, the violent, engineered confession that professionals have completed their work and require one final liquidity event before launching the move they have spent weeks or months preparing. The trader who understands this does not abandon their position at the spring. They recognize it as the precise confirmation they were patiently constructing their entire analytical framework to identify. The breakout is not the opportunity. It never was. It is the public announcement of an opportunity that was available exclusively to those who studied the range, read the volume, identified the phases, survived the shake, and positioned themselves at the last point of support while the majority was still waiting for something exciting enough to capture their attention. And context, the dimension most consistently overlooked by technically proficient traders operating across every modern market, is not merely an additional consideration to incorporate into your analysis. It is the foundational lens through which every structure, every event, every volume reading, and every trading decision must be filtered before a single order is placed. A structure without context is a word without a sentence. Precise, perhaps. Meaningful, never. In today's markets operating across 24-hour cryptocurrency exchanges, algorithmically driven equity futures, high-frequency foreign exchange systems executing millions of orders per second, the instruments have changed beyond anything observable in my original era of study. The law governing all of them has not changed by a single principle. Supply and demand construct their campaigns in ranges. Causes produce proportional effects. Volume reveals professional intention. Shakes generate the liquidity required for explosive moves. Breakouts reward those already positioned. Context determines everything. These truths were operating in the stock markets of 1910. They were operating in the commodity markets of 1950. They were operating in the equity markets of 1990, the currency markets of 2000, the cryptocurrency markets of 2020, and they will continue operating with identical precision across every financial instrument humanity develops across every generation that follows. The trader who genuinely internalizes these principles does not merely improve their technical analysis. They fundamentally transform their relationship with financial markets, moving permanently from reactive participation driven by emotion and urgency to deliberate engagement driven by comprehension and patience. The sideways market you were about to abandon contains the most significant opportunity currently available to you. It always did. You simply now possess the understanding to recognize it before the move begins, before the breakout fires, before the crowd arrives desperate and late, positioned exactly where the professionals have been quietly, methodically, and invisibly building everything that comes next. The range was never the problem, it was always the answer.